You're listening to the Real Estate Runway podcast powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family, today we're welcoming back a special guest from episode 19, way back in the archives, a member of my team, Miss Amy Sylvis of Sylvis Capital. She is an alliance partner of Quattro Capital, a brilliant market research mind, a brilliant underwriter, a brilliant deal maker. I've done a lot of deals with her. And her and I were on the phone on Friday just talking about where we have been, where we see things going. And we're like, this should be a podcast. So get ready. We're going to get into this episode and you're going to hear basically Chad and Amy get on a soapbox and just talk what we know about currency, economy, where we've been, where we're going, why the cause and effect relationships have behaved that way. I'm super excited for this episode, so let's get right into it. Here we go. All right. Welcome, Real Estate Runway family, to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton. Before we get started, folks, if you get any value out of this show, please scroll down and leave us a 5-star review and maybe a thoughtful comment. Those ratings and comments are worth their weight in gold and are the only way to increase the reach of the show. You can also follow us via our parent company on Instagram, Facebook, LinkedIn at Team Quattro Capital, one word, no special characters, or simply by visiting us at thequattroway.com. We really appreciate all of our listeners out there, and we'd love to hear from you. If you have any content requests, feedback, just want to say hello, drop us a note at podcast@thequattroway.com. And if you'd like to apply to be on the show, please visit us at thequattroway.com/podcast. And now on to your scheduled production. We are joined today with a repeat guest, member of the Quattro Capital team, Miss Amy Sylvis. If you want to go back and listen to her previous episode, go back all the way to the OG back in the day, episode 19. What are we on now? 76 or something? As of this listen, it's probably broken 100. Episode 19, Making Life Better Through Multifamily Real Estate with Amy Sylvis. She's a good friend of mine. Her story is incredible. But what she will never tell you until you get her on a podcast and ranting is she is a fellow Federal Reserve and economy nerd. So, Amy, welcome back to the show. How are you? What have you been up to, my friend?
Chad, this is so cool. Thank you so much for inviting me back on. I know just a few days ago, we were just ranting to each other on the phone about current events. And we thought, wait a minute, let's pause. We've got to record this and, allow other people to listen to us and our brains go on this great topic. So it's such a pleasure to be back. I know since the last time we recorded, you and I have done a whole bunch of multifamily deals together. It's that hashtag grabbing assets, right? As we continue to build our portfolio and our wealth and, of course, serve our residents and our investors. So it's been an incredible ride.
It has been, Amy. And, I missed on that. I was wearing that shirt yesterday that says hashtag grabbing assets across the front. So I should have worn that today for you because you would have called me out on it. But yeah, no, as Amy mentioned, we have done a number of deals together, and seen a lot over these last couple of years. And really what I'd love to do, Amy, I'll let you kick it off. We're currently, as of this recording, it is October 7th, 2022. We are now 10 months into interest rate hikes and, further deviation of buyer and seller sentiment on really any commercial real estate asset, yesterday's pricing is no longer financeable under those cash flow streams. Let's just kind of take it back a minute and let's think about how did we get here, right? This is, to some people, this came as a surprise, an accident. But let's start the conversation there is what has been building to this point in pre-2022 to kind of set the stage for the actions the Fed has had to take, in your opinion?
Yes, I love this, Chad. And I think, to your point, you and I both love to study monetary and economic history, right? Because it allows us to see patterns and maybe project into the future. So I think it is important for us to talk about what has happened. And as we all remember, starting in March of 2020, there was a pandemic. And as our dear friend and your aunt, Kim, says, we intentionally shut down the United States and big parts of the global economy to save lives and for health. But the Federal Reserve, in order to support, the intentional shutdown of the global economy, increased the United States currency supply by close to 30%. So such a massive increase, something we had never seen in the dollar's history. And as you can probably guess, there have been a bit of things that have come forth from that action that was, I would argue, necessary over 2020 and 2021, but we're dealing with those consequences now.
And let's talk about that for a minute. So first of all, you mentioned we shut the world down in March of 2020. That seems very like we all just accept that now because we lived through it. But let's be real. That's like the first time that's happened in the world since Noah's Ark or something like that. I
Right.
mean, I don't know how
Yep.
far back you have to go to find that again. That was a
Yeah.
monumental problem, right? And
Right.
so why, in your opinion, was printing money? I mean, we're not here to argue whether it was necessary or not, but what was the effect of printing money, right, in the economic machine?
Yes. I mean, to your points, shutting down the economy could have blasted us back to the dark ages and a depression that none of us could ever imagine. So being able to continue to have money flow through the system and have the system not collapse economically is not hyperbole. It truly kept lending going, which is obviously in our world very important, but allowing all business to continue. So we were able to feed, house, I mean, everything, every basic economic activity that's necessary to maintain civilization. So these are big words and big statements, but truly it was something that needed to happen. But as with all things, there are consequences. So we're living through that right now.
And let's talk about those consequences now. So, let's fast forward a little bit in the story. All of a sudden you start to hear a lot of the naysayers or doomsdayers, as they were termed. Inflation is coming. Inflation is coming. It's like Paul Revere, but inflation is coming, And then here we are and inflation came, right? Wasn't really a surprise to us because, as you mentioned, for the first time in our modern lives, we increased the money supply by, nearly half of what it was before. And so talk a little bit about the supply and demand of currency, because I think people have a hard time wrapping their head around fiat currency versus real. And we won't go into that here, but why does supply and demand matter for the dollar?
Right. When I think, Chad, it goes to the definition of inflation, right? I think a lot of people think that inflation, or maybe would argue inflation, is the rising of prices. But I would argue the true definition of inflation is simply an increase in the number of currency units in circulation. Rising prices is simply a symptom of this occurring. So to your point, if we're increasing the currency supply by 30%, yes, we're not going to be surprised that prices increase maybe a similar amount. And as you said, maybe not everyone kind of thinks through it that way, but just imagine more dollars chasing the same amount of goods and services. If all of a sudden, you and I have $1, but if all of a sudden we both have $2, well, we're able to pay a bit more just by nature of how much money we have, pay a bit more maybe for the same amount of fixed goods. We won't mention the supply chain issues and all of that, but there were a decrease in amount of things to buy as well during that time.
Well, and that's a very important point to make is remember, we shut down the economy, which means we shut down production of virtually everything in the world for a little while. So we've seen people talk about lumber prices going up. We've seen people talk about transportation prices going up. I mean, really anything that someone had to spend time to create or provide a service, price went up because all of a sudden there was scarcity there. Oh, by the way, we all have more money in our pockets. And so if I wanted, I'm going to use a terrible analogy, but if I wanted a Big Mac from McDonald's and all of a sudden there were half as many Big Macs in the world because McDonald's stopped making Big Macs for an entire year, right? But demand was still there. Well, naturally they can say, hey, I'm going to charge a little more for this because demand is there. Well, and you can't really just say shame on big business because they raised their prices. We paid it, right? Price is made because we agreed to pay it. If nobody paid the price would have went back down. But so there's two sides of the equation. But point is now you have, instead of $1, you have $2 in your pocket. So maybe you're willing to pay $1.25 instead of $1 for a Big Mac because you're hungry, So like this is the nature of how we kind of got hit from two sides here with not only the supply of money increased, the supply chain of virtually everything decreased, And so we have supply and demand of the goods and increase in supply of the dollar. So the net effect of that is inflation. Anything to add to that?
Yeah. I think the one thing I would add, and maybe this is a little bit of a tangent, but I think it's worth mentioning, this increase in currency supply, anytime a central bank does this, that increase in dollars or whatever the currency unit is, isn't distributed equally. It's typically distributed to those that are the most connected and the most powerful in society, which ends up meaning the rich get richer and those on fixed income and those with less income tend to not get access to those dollars as soon, but their prices still rise. So it is a regressive tax when currency is created. And unfortunately, that hits the most vulnerable in society. So I think that's important to mention because I think some people, rightfully so, get upset about what we see happening to some of our fellow humans in the U.S.
And I love that you fielded that question so well, because I just committed one of the 7 deadly sins of a podcast host saying, do you have anything to add to that? So I'm glad you fielded that question. I'm not supposed to do that as a host. Shame on me. Shame on me. But, bringing it back to real estate a little bit. So we've kind of talked about the why behind things and the cause and effect relationships in the macroeconomic economy. But when we start to think about, okay, what does that mean to real estate? Well, what's the number one thing we use in real estate to multiply our wealth? The answer is leverage. Now, there's irresponsible use and responsible use. We're not going to get into that, right? But the point is, most of us use some form of leverage or debt to buy these properties. Now, let's talk about why we saw prices in real estate skyrocket like 20%, after the pandemic. Well, part of it is, we had a reduction in supply of deals because things just didn't sell. It was uncertain times. So sure, some money was on the sidelines, but people still wanted the asset. Well, then we come out of this, all of a sudden, and as you mentioned, mostly people who have control of wealth have more money. And we're still now going after the same assets that are reduced in supply. And guess what? Money was still basically free. You could basically still go get a loan for 2 or 3% at, 70 to 75, 80% of purchase price or cost. And in my mind, that has just basically created a perfect storm for I can pay whatever I feel like because A, I have more money that was given to me. And B, I have effectively free money because if you're borrowing at rates below inflation, which we know that even before it was reported has been greater than 3%, it's basically free money. I mean, what are your thoughts on that whole situation?
It's mind blowing. And I think, again, it goes back to you and I studying monetary history. And one of my reasons for getting into this space, because, in a time when inflation is high and inflation is inevitable in the type of monetary system we have, that's another conversation. But those who are borrowers are winners. To your point, you and I think the last deal we closed, what was our interest rate? Maybe 4.25%, maybe even less. And inflation
worst case at the time. Yeah.
Yes.
I think it was 3.5 when we closed.
Okay. Memory. Yeah. It was even better. And inflation, as stated by the government, was 8%. So our real rate was negative, which is amazing. So
let's do that math. Negative 4.5%, right? I mean, that's what we were paying effectively.
Yeah. So we're being paid to borrow money. We're paying the loan down with decreased in value dollars. So that inflation-induced debt destruction, that term that you and I love to talk about, we can dive into that as well, with cash flowing asset in areas where people were migrating and their jobs were great. So we're able to raise rents on them. Yeah, quite an amazing scenario. Now things have changed a little bit, but I'm proud of us for really taking advantage of what we were able to do and what was offered to us at the time.
So let's take it into so we've gotten to where we are now. Let's talk about the now for a minute, and then I want to talk about where we see this going, because this is kind of where it gets fun, right?
Yeah.
But the now, in my opinion, let's talk a little bit about assets versus productive assets. And when I say productive assets, I'm talking about things that, like an apartment building. I buy the asset, people actively pay me for a service, which is providing housing, and it is therefore producing some form of cash flow. And the reason I bring this up, Amy, is you have a lot of people who got a hold of this money. Some put it in the stock market, which is a speculative asset, and some put it elsewhere. So that's fine. But when you're buying productive assets where people can pay you in whatever form of currency, that even if the dollar goes away tomorrow and they need to pay it in silver or carrots or green beans, like whatever we decide is the new currency for rent, it's still a productive asset. And therefore, my mindset, and I'd love to hear your take on this as well, is that we should be going into debt hand over fist right now for productive assets. Now, I caveat that with responsibly. I mean, of course, if you go into too high of debt, you will lose the asset. That is a different situation. But as long as you're doing it responsibly, going into debt hand over fist because of this term, inflation-induced debt destruction. So let's talk about that a little bit and maybe come at it from what does that mean, inflation-induced debt destruction?
Yeah. So I love that you said that, Chad. And I agree, about getting as much debt as we can on assets. And I love the definition that Robert Kiyosaki uses for an asset. An asset is simply something that puts cash in your pocket every month. A very simple definition. So that is not capital gains, by the way, right? That's cash flow. So inflation-induced debt destruction, a term that I love, I didn't invent, so I can't take credit for that there. But essentially, let's all think back 10 years ago and what maybe $100 purchased you. What did it buy? And what does $100 buy for you today? Well, you get a lot less for your money with that $100 today, right? So that is a reduction in the purchasing power of that dollar. So now let's think about if we're borrowing something today, let's just say $1 million, we're borrowing that today, and use that as same analogy, 10 years from now, how much is that $1 million worth? It's probably going to be worth significantly less. So you're paying down your debt month after month with dollars that are devalued. So essentially, you as the borrower are on the winning side and the lender is on the losing side. And this is a huge benefit as an investor above and beyond the cash flow, above and beyond, all the other things, appreciation that we can get. Winners are debt borrowers in situations like this. Chad, am I going where you want to go?
No, you really are. And I think, taking it a step further, let me go the other direction. Let's say you borrowed $100,000 to buy a medium-sized apartment community in 1925. Okay. Let's say, okay, well, if you go and Google, you can Google this. What is $100,000 worth in today's dollars? It's going to be a lot less. So if all you did, let's just say you had an interest-only loan the whole time, right? And oh, by the way, cost of living continued to increase, rents continued to rise, wages continued to rise, which means you can charge more rent on that building. Well, guess what? You're going to look up in 2022, 100 years later, and it's worth what? At least $1 million, probably at least 10x. Google the numbers and fact check me on this, but that is inflation-induced debt destruction, because what was effectively probably felt like a $1 million loan to you at the time is now worth a tenth of that. And so let's take it to a hyperinflation scenario. We have not experienced hyperinflation, folks. That this has been inflation and stagflation, arguably, depending. But let's say we got into a hyperinflation scenario, right? To where, okay, all of a sudden, like it started costing $20,000 to buy a carrot or something crazy, right? So like it's mind boggling, but think about that. Think about where let's say you took a $20,000 loan for a car. Don't do that, but say you did, right? That's not a productive asset, by the way. I'm not sanctioning that purchase. But if you took a $20,000 loan for a car or so whatever you could buy with that money, and all of a sudden hyperinflation took place and that $20,000 will only buy you a carrot. Well, guess what? You can take that carrot and now you own your car outright when you go pay off your lender. That is inflation-induced debt destruction at its finest, folks.
Spot on, Chad. And I think that is so far outside of anything we've thankfully ever had to experience in the United States as Americans. But it's a very real scenario throughout the world, whether you're talking about Zimbabwe, Venezuela, even what's going on in Turkey right now. Yeah, this is a very feasible scenario that could happen. But even at a smaller scale of what we're experiencing in the US right now, with whether you want to call it 8% is the CPI or, 15%, whatever, pick your number, the principle still remains. And it's still a really powerful wealth generating tool that I think is invisible to a lot of people. So I love that we're talking about yet another benefit of owning commercial real estate.
Yeah, and let's put that equation together, Amy, right? Because let's just, for round numbers, because nobody can agree on the freaking number, it's 10%. Let's say CPI is 10%, okay?
Yep.
Well, yeah, rates are not 2 and 3% anymore. We're not at Disneyland anymore, the happiest place on earth for interest rates. But let's say that now your rate is 7%. Let's give you some credit, 7%. Okay, you're still making 3% on that money as opposed to you using your own money in place of that debt. So and then let's couple that with you buy a building. Let's say returns are lower now because we're worried that rents are going to drop. I'm giving you all the credit, audience. Okay.
Yeah.
So let's say that returns on a building are only 10% per year, right? And when all is said and done, you've now made 3% on your debt per year, and you've made 10% on the property per year. So you're growing wealth on both sides of the coin by using debt. So anyway, is that making sense, or did I kind of go on a tangent there, Amy?
I think it's fantastic. It makes a lot of sense to me. And it's so important to utilize these concrete numbers so people can visualize, because gosh knows Wall Street isn't teaching us about this, and neither is the education system, right? So let's spread the good word, Chad.
Yeah. And I'm gonna do one thing here, and you can slap me for this later. You might agree. I am not a doomsdayer, folks. I promise you. I'm not one who's hoarding gold and silver. I do have gold and silver, but I'm not a hoarder of gold and silver. Fact checked us on this. The dollar has depreciated since its inception over 95%. If you go look at what a dollar would buy you when it first came out versus what it will buy you today, it is depreciated over 95%. That means you can literally buy like 5%. I'm doing the math easy for you. You can buy 5% of what your dollar bought you back in the day. And so if you think about that, and now let's take things back, and I'm going to quote Ray Dalio here, right, with his Economic Principles book and Changing World Order, brilliant owner and operator of Bridgewater Associates, brilliant economic mind. But he has spent a lot of time and effort studying other cultures and other monetary systems and just understanding the cause and effect relationships behind why economies grow and die. No currency in the history of the world, zero, has survived 97% inflation, okay, or 97% devaluation. We are at 95 and change, and consumer price index is somewhere between 6 and 15, depending who you ask. So I'm just going to leave that there for you, and just know that this is a real thing, and that in our lifetime we may very well see a new currency as well as us cease to be the world reserve currency. Hope I'm wrong, but I'm gonna break my rule again. Anything to add to that? It's okay if you say no.
No, Chad, I think it's important for us to remain grounded without doomsday. I really like that you said that because we need to understand the reality. We need to understand the history of what may be coming down the road, because there is so much in our control when we do have that information. This is not a doomsday scenario. This is something where we can empower ourselves with knowledge and action. You and I are both doing that. If you and I can do it, other people can as well.
Sure.
Through really understanding what their options are. So I don't see it as doomsday at all. I see it as incredibly empowering, and shame on us for retaining this information just to ourselves and not helping to spread it so others can benefit as well. So we're all better if we're more prepared for what may be coming down the road.
And before we go into the future of where we think things are going, tell me your favorite saying one more time about what is history. It rhymes or something like that.
Yeah. So there is, so two of them. So history doesn't repeat, it often rhymes. But I think Winston Churchill said, the further into the past you look, the further into the future you can see. That I think is incredibly powerful.
Yes. And I also believe he said, give me a control of a country's money supply, and I care not who makes its laws, or something like that. So there's a lot of fun things. Did he say that, or did I get that wrong?
I don't think so. I think that may have been Keynes, or maybe someone more sinister. I don't remember.
Look at me. I'm getting like, fact checked live here. It's cool. So I'm not upset, but all right. So let's take that. Thank you for that, by the way. Those are wonderful sayings, and they're right. I mean, history doesn't repeat itself verbatim, but it definitely rhymes. And if you study histories of cultures of money and everything like that, you're going to see that. So, okay, let's pivot this direction, Amy. We've been to what got us here, the cause and effect relationships. We've talked about what's going on now. Let's look into the future a little bit. So, most people listening to this show, as are commercial real estate investors or, operators, investors of sorts, lenders. We have had access to a lot of data, a lot of public figures, and just a lot of points of view on where is the economy going, where are interest rates going, more importantly, and what does that mean for our world of investing, commercial real estate. So I'm gonna let you lead off here, and I'll, of course, have my opinions as we go.
We're in such a fascinating time, Chad. I love that we're talking about this because I think I sent you a message or to our whole team on Slack that the UN asked the United States to stop raising interest rates because it's having that much of a detrimental impact on the economy. And I really think, the Fed is stuck in between a rock and a hard place because I think people understand that their currency creation, even though, let's give them the benefit of the doubt, it was well intended. But inflation numbers, the way that we've seen them, are awful and they really impact people and they have to take action. But we also know, and I think the Fed secretly does as well, that every time they raise rates, especially at a clip like this, the economy does pretty poorly. So what are they going to do? Are they going to have raging inflation, or are they going to crash the economy? I say crash a little hyperbolically, but induce, a bit of a recession. So, I really firmly believe that we are probably going to see rate cuts sooner rather than later. Chad, I think you actually had a great statistic about the time when the Fed starts hiking, on average, how soon they start cutting. So I'm going to toss it over to you to elaborate if you'd like.
Yeah. And I do want the listeners, by the way, to go fact check me on this, because this is very easy. Go to fred.com, F-R-E-D, and simply create a plot of the Fed funds rate and it will automatically overlay recessions for you, the little shaded areas. This is a great thing to look at. What you will see is in the history of the Federal Reserve, within an average of 2 years and a max of 3 years from the first rate hike comes the first rate cut. And why is that, right? And by the way, 2008 was the 3-year time frame. So that segment. So that the fact that they made that mistake actually, and they held too long at high rates, actually partially contributed to the financial collapse that we had. There was many other things. It was not one thing. But so I don't think they'll make that mistake again. So why do I say this? Let's go back to our commercial real estate analogy we talked about.
Yeah.
If we go back to the commercial real estate analogy we were talking about, let's come back to the situation where all this money's been printed, people buying, let's just say commercial real estate, are more liquid than ever, and now and oh, by the way, debt is still really, really cheap, like 3%. Well, I'm just going to buy whatever the heck I can get my hands on because I've got, and whether it makes sense or not, because I know it's going to grow at this point. And so the only way they can fix that is they say, okay, well, guess what? Your 3% debt is now 6% debt. And that's what they did. They aggressively hiked rates and this is not just real estate. This is to prevent anyone who's buying businesses, real estate, whatever you can buy with leverage, right? To slow the hell down and try to regulate prices, because that all has a trickle effect and goes to consumer price goods and all that sort of stuff, right? But in effect, whether it's a small business loan for someone producing goods, money got more expensive, okay? And that creates some kind of economic heartburn, especially the further you go, because all of a sudden people who need that money for operation of their business or to provide goods or services can't get it or they can't afford it, right? So things start to contract, the belts start to tighten, people might lay off workers because, hey, I can't afford that payroll that I was buying on line of credit or whatever it is, right? Credit makes the world go round. And so why am I saying this? Take it all back to where I think we're going in the future. We are on the clock as of January 2022. That was when the first rate hike came out. Okay. We are now in October. We're 10 months in. If we play the law of averages, we should be probably the end of 2023 at the latest by the time we see the first rate cut. Now, I'm a betting man. I like to assert my opinion because I love being wrong. So I'm going to do that. I think based on where the CPI that the Fed is publishing and trusting is at, we're probably going to see 1 or 2 more rate hikes. I don't think they will be 75 bips. It may drop to 50 and then it may drop to 25 and then they'll quit. But what may happen is we see a drastic reduction in productivity and GDP. And what do they have to do now to stimulate the economy? They raise rates to slow it down. They will then have to turn the corner and start cutting rates, probably in a V shape, as in about face and go down, to start stimulating productivity and growth again. Now, and this is my last point, and then I'll turn it back over to you, but I'm under no illusion that we're going to get to go back to Disneyland where interest rates were the happiest place on earth and we got spoiled, right? But we're probably not going to stay at the point that we are. We're probably going to level out somewhere sub 6%. If I have my aggressive projections are like 4.5%, my pessimistic projections are like 5.5%. All still good rates for commercial real estate or any real estate, So anyway, I'm going to step off my soapbox, but that's kind of where I think we're going. Where do you think we're going?
I couldn't agree more, Chad. I really think history shows us, again, there's that history word, that the Fed does act too late in both rate hiking and rate cutting scenarios. So, and I'll go one step deeper, having a central authority kind of plan such an important part of the economy. And, we just know again from history that they tend to not always get it right. So I do think we're probably going to be in for a little bit of economic pain. I'm not scared of that because it doesn't happen equally throughout the United States, right? So we're very smart as investors in terms of where we invest. But I do think it is going to prompt the Fed to have to cut rates. I think in 2023, if I were a betting woman, I'd guess Q3 myself, maybe even Q2, because I think there's going to be pressure not only from American citizens to get the economy going, but I think a lot of us understand that what we do in the US is, can impact others. I mean, there can be strikingly awful economic things that can happen because we are the world's reserve currency and we are the world's reserve superpower. And Europe, keep a very close eye on Europe. They're going to have some economic pain soon. And as some of our closest allies, I think there may be some negotiations there just in terms of bringing back easy money. So one last thing, the euro is now at parity with the United States dollar. And if you saw the pound just a week ago went to 1.03, something I don't think, Chad, you and I have ever seen in our lifetime. So
No,
we've got some interesting things coming, without a doubt.
we do. And that point is very important, that remember, we are all connected globally, economically, whether we're countries or one world government or whatever you look at it as, we're all connected, because of international trade and things like that. And so every decision we make here, just because other countries, own or will have debt to other countries. I mean, it affects everything. And so that's exactly what you're saying. Let's hyper focus for just a moment, because we're getting back to what we do, and that is, buying value add multifamily. And we know that it's been something that's been going for a long time, but we're still doing it. What are your thoughts on why in this environment, our company is pursuing, more like Class B to low end Class A transitions instead of, we all used to do low end Class C to Class B transitions, which was a very different income group. So what are your thoughts on that statistic and plan, as we go forward?
Yeah, I love that, Chad. I think it's such a smart point because, I'd like to bring up two separate topics. The first one is, we're seeing in real time, organizations like RealPage are tracking how much rent increases are tolerated by these various asset classes. And without a doubt, Class A and Class B folks are really absorbing rent increases a lot better. And, that gives us a little bit more runway if, God forbid, things slow down. They are probably going to be able to continue to absorb, maybe not as large rent increases, but we can kind of infer that that will keep us and our investors safe as we continue to execute our business plans. And, as I mentioned earlier, we think about Class C folks. They tend to be the ones that are disproportionately impacted by this currency creation or higher inflation. So I think both of those things really prove out that we should really be focusing on folks that, I don't know if I want to say renters by choice, but definitely folks that make a little bit higher income and I think can weather a recession or a high inflationary environment a little bit better.
I love that. And I'm even going to pull away from talking about Class A, Class B, Class C. Folks, you need to be focused on the rent to income ratio of any project you're investing in, buying, whatever, because unfortunately, the classes of renters have kind of become disproportionately affected by the real estate trend that we've had. So if you look at most Class C renters in the area, and that's going to be buildings that are like 1960 to 1970, usually moderate crime to high crime, usually renters for life, and some sort of a labor or service worker that, guess who's the first one to get cut when a recession comes, right? Unfortunately, they have been enduring these renovations and rehabs for quite a bit of time now. And so if you look at that rent to income ratio, folks, you might be seeing they're already at 35 to 40%. We don't write leases in our business unless it's 33% or less, and so how are you going to justify a business plan that, you can go raise rents, but your delinquency is going to go through the roof because they can't pay it anyway, especially if their grocery bill just doubled, their gas bill just doubled, and they're already living paycheck to paycheck. That's a really, really tough industry to try to work a value add plan on. Whereas you look at someone who is in the, maybe they're a upper end blue collar or white collar worker or renter by choice. Maybe they own a business or something and they just rent because they want to. But their, rent to income ratios on the projects that we've been doing are like 15%. So you have a long way to go before you really start to struggle with affordability. So anyway, my 2 cents, that is the number one metric, I think. Well, it's one of many, but that is a very important metric that we are going to continue to watch as we stress, doing plans, doing value add plays where affordability doesn't become the problem,
I love that, Chad. And I think you and I have even kicked around the idea of, how could we support some lower income or fixed income people within our units? And I think that plan could become more easily to fruition if we do have kind of folks that have a little bit more buffer for increased rents. So I don't know if you want to go down that road, but I just thought I'd drop that in there because I do think that that's a really exciting thing that we can do. And I think being strategic about the class of asset that we choose to invest in could help us achieve that goal.
No, I think that's very important. And what she's talking about, Quattro Capital has a very, one of our 4 pillars is philanthropy. And we take that very seriously. First it's people, then the property, then the profits, then the philanthropy, right? So we have to do all things in that order. And that's how we really make a lot of our decisions. Well, it's come to our attention on some of our assets that are doing very well, especially that, sometimes we come across a renter who may have been there for 20 years, or maybe they're on a fixed income, or maybe they're just not poised to be able to handle this. And unless we can place them in another, equivalent unit or complex that may be a sister community, we're trying to figure out how do we bake into our plans the ability to say, okay, maybe 5% of the residents, or we're just going to keep them at low rent, and I would argue that if you can't make a plan work with that, you shouldn't be buying that project, So anyway, there's, it's not always about just making money. It is about creating communities and taking care of the people. And yes, we're operating a business. Yes, we have to offset increasing costs. And yes, we do feel that especially when we spend money on a unit, we should ask market rent. But there are always going to be folks who just have extenuating circumstances where they can't do that, and so we want to be in a position to help and give back in that world as well. So thanks for that plug. I appreciate it.
Yeah.
Well, Amy, thank you so much for coming on the show. I really appreciate it. If the listeners would like to reach out to you personally, what's the best way to do that?
Yeah, so sylviscapital.com is my website. And I'm also extremely active on LinkedIn with a heart to add value to folks that follow me there. So hopefully Chad can put both of those links in the show notes. And yeah, would love to keep in touch.
To say extremely active is an understatement. She's always on the damn thing. So yes, if you look for Amy Sylvis on LinkedIn, you will find her. She's there and a very accomplished author and what webcaster or whatever on there. So plenty you can learn from Amy. All right, everybody. So don't forget, if you got any value out of the show, please scroll down, leave us a 5-star review and a thoughtful comment. Those are the most valuable things you can do for this show to help us reach others. You can also follow us via our parent company, Quattro Capital, on Instagram, Facebook, LinkedIn by searching Team Quattro Capital, one word, no special characters, or by simply visiting us at thequattroway.com. Until next time, this has been another episode of the Real Estate Runway Podcast. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.